Oh, there we go.
Yes.
My apologies.
No problem. Hey, Dave. Good to see you again.
Hi, Chris. Always good to see you.
Good. Well, why don't we get started now that we've got the star of the show here? And so thanks, guys. We've got a number of callers and folks who dialed in for this call. And with me is Dave White, who is, and I'll try not to screw this up, the EVP of supply chain for NFI and the NFI Group. So not just the North American operations, but also responsible for the UK operations, plus trying to find a bunch of the other pieces of the puzzle. Dave has been with NFI, I think your bio said 1998.
That is correct.
So certainly been through some of the wars, but really running supply chain, I think, for the last, well, probably since 2016, I think. And so what we wanted to have is a conversation with David, which actually started with a conversation at the AGM, where I asked Dave pretty simple questions like, do you guys have this? And he just looked at me with that funny little grin that you probably just saw. And he said, yeah, I think we're pretty good. I'm like, okay, well, then let's talk about this, because supply chain issues have been, as we all know, probably at the root of some of the issues around earnings and some of the issues over the last few years. So with that, I'm going to turn over to David. Maybe I'll let you do a little invite for yourself and maybe take it away from maybe setting the frame up from where New Flyer sort of started from and what happened in COVID.
Will do, Chris, and thanks, and hello, everybody. Yeah, so I've been with I started out with New Flyer, just in the New Flyer transit side, 1998, and I'm originally a chartered accountant, and I spent my first 5 years in finance as a corporate controller. But I've been in supply chain now here for 20 years, over 20 years. And in my role as a vice president or executive vice president for all of that. So I think the starting point in our business that I think a lot of you would understand already is the complexity and how critical the supply chain is to us. When we build a transit bus for one of our customers, we source over 10,000 parts to build that transit bus. That's just us. That's at the level of our part numbers. An engine would be one part number in that 10,000, right? A BAE, which is a multi-billion-dollar company that supplies us hybrid power systems, they'd supply us 3 components, for the drive motor and the power electronics. And they're one component for power electronics. I asked them when I was at the show, it has 10,000 parts inside it. And that's one part number of our 10,000. I used to estimate that at tier 2 in our supply chain, if you had all our suppliers' bills of materials for what they ship to us, you probably have about 250,000 parts. I'm pretty confident it's over 1 million parts. Just has to occur between our direct supply chain and our suppliers' tier 1 direct supply chain. 1 million part numbers have to come together. So what? You say so what, but it's an engineered to order business on top of that. So every contract we build has hundreds and hundreds of part numbers which are specific to that contract. Electrical harnesses are specific to that contract. We build all sorts of different bus models, different powertrain systems, etc. Just New Flyer Transit alone, because I know the number, 200 new part numbers every day. So the ability to build up inventories well ahead of time, etc., when you're in an engineered to order business is different than it is for other businesses. The other aspect of that, and you can see it in our parts business, or you can see it at Home Depot, that when you get 99% of your parts in our parts business, or you get 99% of your things on the shelf at Home Depot, nobody notices the 1% that's missing. Let them make the substitutions. But when we're missing 1% of our parts, we can't build anything. And if it's the wrong part, if it's the flooring in a bus, if it's the engine in a bus, if it's what our biggest problems were last year, power electronics, the bus can't operate, it can't run. And you would have heard when we couldn't get microprocessors for our main controller in our vehicles, in our New Flyer vehicles last year. We built buses for 3 months without our main controllers. That means none of those buses are running. That means none of those buses are getting all their electrical systems checked out and validated. That means you put thousands of hours into the yard, which one part number needs to come in, but thousands of hours of electrical validations, road tests, everything that you have to do to check out the vehicles is all stacked up in the yard. So any individual one part number can be very painful in this industry, in this business. And with the customization, et cetera, it's quite a challenge. So why I'm confident big picture is I've been here doing this for 20 years. We had scheduled prior to COVID. Our focus has always been on a very strong performing supply chain. It's always been on partnering with the best of the best. We don't move supply around to save 5% on a supplier who performs and ships to us on time with high quality. We don't do that. We are the leader in the industry. We support the leading suppliers that supply to us. We design them into our product. And for a 10-year period before COVID, our schedule attainment was 100%. 100%. When COVID came, of course, the first letter that came to me was Cummins in February of 2020, when a lot of you would have just been hearing about this virus in China. And I got a force majeure letter from Cummins saying there's 100 parts on our engine that come out of that region of China, and we may shut you down in 6 weeks. Well, it was very quick, before all of us were in our houses with a 10,000 part supply chain of 400 suppliers, that we knew we couldn't build anything. It came very quickly. And of course, we shut down production for 6 weeks across all plants. We shut down our motor coach production of our J coach for 18 months because the market had crashed. So 2020, when we came back into production, there were lots of inventories that existed everywhere. Our suppliers had inventories, we had inventories. 2020, we ramped production back up a little bit and everything was good. And then in the first quarter of 2021, problems really started to come. The supply and demand imbalances that occurred through COVID and the shifting buying patterns everyone had as they sat at home and ordered their fridges and everything else, there was massive problems in the supply and demand equations across all sorts of industries. And the most well-known one, of course, was microprocessors. And our bus has hundreds of microprocessors on it. I would say we have 50 of our top 100 suppliers that give us product that have a microprocessor in it, from camera systems to door controllers, to engine controllers, transmission controllers, to inverters. 50 of our top 100 suppliers have microprocessors. So by the time the middle of 2021 and into late 2021 hit, the supply chain challenges became overwhelming. We had everything from local machine shops that make metal parts shut down for 3 weeks because they had COVID in their plant, to all sorts of tier 1 suppliers that simply couldn't get critical items in their supply chain. We had 30 to 40 force majeure letters from our top 150 suppliers saying, I'm sorry, I just can't meet your schedule, and here's what it is. The problem was the lack of visibility, and the problem at the time was knowing when it would be over. I've been asked many times about what would you have done different, and I'm not sure I know the answer to that. Because if we had shut down our operation and not pounded through it, what would we have done with our 3,000 people who know how to build a bus? And what would our whole supply chain have done with all their people that know how to make those parts? So we had to power through it, and we did power through it. Our parts availability at the worst of times was still over 98%. We were only ever talking about 2% of those 10,000 parts, but the type of parts and the pain that was caused by them was catastrophic. To where we hoped it would be better coming into 2022 in late 2021 after we experienced 8 months of it, but the truth of it was it got worse with China, COVID, and the electronic supply chain got worse in 2022. And I would say the peak of the problem was probably the middle of 2022. And to use New Flyer, and it was across all our businesses, it was in equal aspects. But New Flyer alone, the biggest business, we had a 62% schedule attainment last year in 2022. So that means we dropped 40% of our schedule because parts couldn't come and we just had to adjust. We just had to, don't do line entries this week, slow this down, et cetera, et cetera, et cetera. As we came into 2023, things are drastically improving. We had to make $7 million of high-priced broker buys on chips in the middle of 2022. We've made 200,000 of that so far this year in the first 6 months. So we've had to make very few broker buys. Our suppliers still are, but for the most part, all of our critical suppliers that were not shipping us power electronics, we have all those parts in station today. There's risks in that supply chain. It's still fragile in certain areas, but all that supply is on time today and it continues to improve. Our parts availability today on the production lines is equivalent to 2018 and 2019. It is on the production lines. Our supply chain is not performing at 2018 to 2019 yet. You know, our on-time delivery is in around 95, almost up to 96% now that suppliers are delivering on time. It was 99% in 2018 and 2019. There are still a bunch of suppliers that aren't able to deliver us to our schedules on time on a repetitive basis. But the issues are different. The issues are isolated to those individual suppliers, labor issues, capacity, ramp up. They aren't these global issues that are impacting everybody. But we're cushioning the production line quite successfully. Even though suppliers aren't performing quite to plan yet, we're cushioning it quite successfully to really, where we're performing now this month at pre-COVID, 99.6% parts availability in station. It's not automotive. Even automotive is not 100% every day, but it's not automotive, in our engineer to order business. But when we're over 99.5%, we're 95 to 97% build in station. It's completely manageable. And that's kind of the levels we performed at. And we're back now to performing at those levels. I have to put a star beside that though. Until your suppliers deliver to you 99% on time, even though you're cushioning it with different things you're doing, you don't know what the future, you're not as confident in the future as you would be if everybody was delivering on time. Like in 2019, we had less than 10 days of inventory. We have more than double the inventory in front of our production lines today, where we're cushioning all sorts of things. So that sounds good, and we have those parts in production, but what does the next 12 months do? You're not 100% confident in that until the suppliers are actually back performing exactly to schedule, because you don't know how when they're not performing to schedule, you don't know what to expect going forward. Having said that, every single supplier that's not performing to schedule today, we know the reasons why. We're on top of them. We have recovery plans, so things are much better. So that was a long speech to give you, the history, what supply chain was like prior to COVID, how bad it got, and where we are today. And I'm sure you'll ask me more, but I sit here with a lot of confidence that we're not far from getting back to where it was at all. We're not far.
Okay, so if we think about where you're sitting today, you made the comment about and maybe if you can quantify this even a little bit to kind of give us some relative numbers. There's still, as you said, there's a few suppliers that are still, giving you some issues, but you said they're isolated issues. They're not global issues. So is there anything that you can, like, how should we think about what those isolated issues are, what the drivers are behind them? Are those going to be things that could come to rear their ugly head down the road, or is this something that looks like it's manageable? Just any additional kind of color or information about how to think about, what that is.
At a very high level, until our supply chain is back shipping to us 99% on time, with only a few little issues popping up like the way it was in the good years, I won't feel 100% comfortable till we're there. Having said that, to answer your question, it out of 400 suppliers, we're talking about 15 or 20 of them is kind of the magnitude. And the types of problems are really focused on their capacity to get caught back up, sustain it, the turnover in their business they've had. We're ramping up. We want to ramp up. All these suppliers have to ramp up. I think I might have given an example, Chris, when we were on the phone last time. I'll just give this example, and there's a lot of companies just like it. We have a seating supplier in Chicago. 2019, prior to COVID, they had 900 employees. We are one of their larger customers. They have other customers in bus and related industry. With all the supply chain challenges and COVID, et cetera, their sales volume dropped over 60%, mostly because chassis weren't available, and they supply a lot of seats into the body on chassis business. And Ford and GM were not sending out chassis. Like, we could only get 150 of the 500 we needed in Arbach, for example, right? We were getting 30% of what we wanted. So their business in 2021, they laid off 450 out of their 900 people got laid off. Now, we roll into 2022, chassis are becoming available. Everybody wants everything back. They had to go out and find 400 people. They've been shipping seats late to us and to Arbach, and Arbach's been putting them on in the yard, extra hours, late deliveries a little bit, pretty good, quite good actually, continuing to be on plan, even though we're putting on in the yard for 8 months. They're 8 months. And we have a daily and a weekly call with them. What's your plan? How's your staffing? What have you hired this week? They shipped into us last week 70% of what they were past due on. So they're very close to being caught up. But that's just an example and a story of a lot of other suppliers like it, that to get back to an industry that builds X number of buses, and it's mostly the suppliers that are heavily invested in transit and industries around it. You know, like our plastic, we're a big customer to some of these suppliers, and we're ramping up. So it's kind of that issue, individual to each supplier with respect to their capacity, getting their feet back on it. Remember, all of these suppliers are suppliers that we had 60% schedule attainment last year. We had to keep sending them reschedule, et cetera. So they're part of our ecosystem to get back to, 2,000 buses. We have 1,900 in this year's NFI plan, and same for ADL, same for Arbach. So it's us and all these suppliers getting back that journey, and it's just those little hiccups to get there.
Are there other industry issues going on though that, like, I got to imagine that, we talked a little bit about the fact that you guys aren't the only ones trying to ramp up production and try to get back schedules fixed to the whole bit. Part of the argument was you were sort of the smallest of all the big guys, and so you were the easiest one to disadvantage. But at this point, do you guys have maybe advantages over your competitors, be it a Gillig or a Nova or someone like that, or is everybody in the same boat?
For the most part, everyone's in a similar boat. Like when we were chasing microchips, that's an item in our supply chain that's common with automotive, et cetera. And it was tough for us to get that supply, and maybe Ford was stealing them before we could get them, type of stuff. But we're down to the issues now that we're past all that stuff. We're down to the issues now of suppliers that are specific to transit, like the seat supplier and the plastic supplier and the harness supplier type issues. I would say we're down to those issues are common for our competitors, and it's a common challenge for the industry. Because as you said, I know Nova Bus is ramping up just like we are. I know where Gillig's at, and I know Gillig's ramping up just like we are. So the whole industry and the number of buses that have been delivered, and a lot of these suppliers supplied to those guys as well, the whole industry has to ramp back up. I will say though that we've spent a lot of time over the years in each of our businesses, and as industry leaders in the UK, as industry leaders in North America in coach and transit, our supply chain has always been a competitive advantage. Our relationships and our buying power, et cetera, has always been a competitive advantage. And I believe we'll get back there. And building buses for Philadelphia, New York, Washington, DC, Baltimore, very discerning customers with very high specifications. We've proven we're the only OEM that can do that successfully, with 100% schedule attainment. And other OEMs that have tried to take on that business, that complexity, have failed many times. So that's a strength of ours, and our relationships, and the strength of our supply chain. And we'll be back there shortly to where it is a competitive advantage to us. Okay.
One of the things, and we've heard Paul talk about it, and I think you and I were talking about this as well, but, as much as it's been masked by, the day-to-day issues, part of COVID, I think, also gave you guys an opportunity to rethink how you did supply chain.
Yeah.
You talked a little bit in our last call about, what you've done with MCI and maybe some of the stuff in the UK, but also the fact that you're a lot deeper into supply chains now. Can you talk a little bit about, kind of what's different now? There's always the caution because it's different this time, but can you kind of maybe lay out why it is maybe different today than it was 5 years ago?
Well, there's no doubt that that which doesn't kill you makes you stronger. I think everyone understands that in every aspect of their lives, and there's a lot of truth to that. You can imagine that the supply chain group around here hasn't gone home at 4 o'clock every day and just said, hey, that's what we have to deal with. We've made lots of changes for the good in staffing. We've shored up staffing. I met with Paul just recently, and we're adding a couple more positions to shore it up for the growth that's coming in the next 2 years. We've made a reinvestment in some staffing related to business process improvement and restoring what we did before. So we're investing in the people to make sure we're ahead of it for the next 2 years. Our engineering, we took the opportunity with all the lost line entries and where our engineering load was at, that we're getting our bills of materials done early. In 2019, a lot of times the bills of materials would be complete 6 weeks before the bus line entered. Right now, every bill of materials complete 11 weeks before the bus line enters. So we're getting our communication out to our suppliers earlier. It's a strength. It's going to improve. It's dealing with some of the suppliers who want the lead times, and with the rest of them, it's going to just improve things. It's more planning, more visibility is happening. We've certainly, we had a supply risk management process before COVID hit, but I would say we are 5 times as informed as to where the risks exist in our supply chain, as to where the vulnerabilities are, like the NXP chip with Parker, and therefore, what are you doing about it so I never see this again? And we are pushing back on our suppliers. They don't like not shipping to us either.
Hey, how are you?
That's their sales, right? When they don't ship to us.
I'm actually on a conference
Oh,
call.
Joey,
Be
need to
back,
go
be
on
back. Great. I'll call you back. Thanks, you bet. Bye.
When our suppliers don't ship to us, they're losing their sales. They don't want that either, right? Not to mention us getting upset with them. So we're working with our suppliers all over the place to put in alternates, backstops, etc., to not repeat what we did. But as part of that, you just fix things that were risks before that you're fixing now. Even though I didn't have a failure in this area, I'm still making changes in this area, and we're doing lots of that. And by far the biggest one, I think, and we're going to start to see the benefit of it. We planned a lot of parts, how much inventory we have, how we buy it, etc. We planned a lot of them based upon thinking that everyone's going to deliver to us 99% on time. It's the opposite now. We're planning every part, and we're going into every part thinking, hey, that part's $7 and it can stop a bus from being started up. Let's plan it differently. And we're going through it. So we're doing all sorts of steps where I'm actually confident we're going to be better than we were before. We're going to see better parts availability when we're done than we did before. I'm talking small numbers, going from 99.6% to 99.8%, but I'm actually confident we're going to be better with all the changes we've made.
Okay. Well, part of the argument in getting better, and I've heard this from a few clients, and we saw this, part of the rationale for KMG was, maybe you guys should just go build more of your own stuff. Like just go ask Paul for a few $1 million and throw some machinery in the factory and do it yourself. Is that even feasible, or does that make sense? Or do we get back into the discussion about if you own these guys, it would have been a lot simpler, or is that just not how this is going to play out?
You can find an area of something we didn't have, and you could say, if we were making it, would we have done better? And you might find 1 or 2 items where you say, yeah, maybe we would have. Plastics. Plastics became a big problem, and actually is a big problem today still that we're dealing with. And I'm trying to figure out the reason for it, but I believe the reason for it when I meet with our suppliers is the fact that everybody was onshoring plastic parts back from China. And every plastic supplier in North America, like thermoform plastic parts, was overloaded with requests for, and we were essentially, some of our key suppliers were almost like one of them fired us on a program, said, I don't want your program. Like, I just don't want it. And he showed me the part he just got back from China at the price he was getting, the margin he was getting, say, I don't have room for that program. You need to move it somewhere else. So you could look at that and say, and we do make plastics. We make thermoform plastic parts at KMG. but we also buy them externally. You could look at that and say, had I known ahead of time, I would have invested and had all this plastics, etc. But you wouldn't have seen it coming. But that's one example out of all of our 50 problems. I'd say 45 out of our 50 problems, you would have never solved them just because you make it yourself. I mean, we weren't getting inverters. We're not going to manufacture inverters ourselves. We weren't getting drive motors. We weren't getting power electronics. That we can't make all that stuff ourselves. We'd need 1 million employees to make this stuff, all this stuff, right? We're not specialists at it. So very focused areas where we should make things ourselves, where our core competencies are. And I wouldn't say it overlaps with supply chain resiliency all that significantly. It does, but for the most part, remember, we still buy 80 to 90%. We still buy over 80% of what we put on a bus.
You know, the other piece of it is, and this is maybe a little bit different and something to think about. But one of the comments you made to me earlier in one of the calls we did, the nature of what you guys buy is changing too, and it's actually changing at a fairly good clip. And a lot of that has to do with the shift to EV, because, you know, despite everything else going on, we're also in the middle of a transition to building a different type of bus. Can you talk a little bit about, you know, because that's an evolving supply chain, that's a new technology, that's, I'm going to guess, I mean, you talked about what, 200 plus parts a day. I'm going to guess a lot of those aren't for, you know, send me a new brand of tire. You know, but there's probably a lot of stuff going on in that part of the world that's interesting too. So, you know, thoughts on how electric is going to change how things are progressing today and tomorrow.
Yeah, an electric vehicle or a fuel cell vehicle has a lot of different parts on it, compared to a diesel bus. There's actually over $300,000 in material cost adds. You obviously get reductions because the engine comes off, the transmission comes off. So it's not the total cost change between the vehicles, but there's a long list of parts that change on an electric vehicle. And the doors change. The actuators that make the doors open and close are electric, they're not pneumatic. The power steering motor changes, it's electric. Like there's a long list of parts that change. You've got
the same sort of labor market, the same sort of inflation levels in July or in September or November. Will you move because you said you feel you need to? Is it time that's going to require additional movement, or would it be reversal in inflation?
Yeah, sorry.
So you don't want to
put them on mute.
Yeah, I'm trying.
Of course, we don't go out of our way to surprise.
What was I lost my train of thought there.
Yeah, sorry. Electric vehicles.
I'm confident in the electric. I'm absolutely confident in the electric vehicle supply chain. I think we've partnered with. First of all, it's a lot of our current suppliers. You know, our current door supplier, our current air conditioning supplier. A lot of current suppliers where their product changes, they're very confident.
Maybe Ashley Kennedy. Do you mind?
Ashley on this one. Oh,
Okay.
you do better now. Yeah.
I'm really confident in all our current suppliers and what their performance level and the world-class companies they are, that they can supply us, you know, the air conditioner that's different than the old air conditioner. It's electric air conditioner. I'm confident in that. But there is a list of new suppliers in that supply chain. I'm also confident in them, but we have to put this in context. We're going to build in the North American business. I can talk about ADL. Well, I will talk about ADL in a second. In the North American business, our zero emission vehicles are going to be up over 3x next year. So, you know, we're going to build less than 400 of those vehicles this year, 300 or in the area of 300 electric vehicles. Next year, we're going to build 1,000 in our production plant. So you've got a little bit of an immature, proven, non-proven supply chain in some of those suppliers. And you've also got 3x going on. So there's risk absolutely in that, but we're very focused, we're communicating, we're making sure it's all in place. You know, one you guys would heard of and can relate to, Ballard supplies us fuel cell systems. You we're not even building 50 this year. We're gonna build 250 next year. So that's 250 fuel cells. At Ballard, it'll be their best year ever with what's going on. So we're very close with Ballard, who's opening up a new facility in Oregon, right? And we have monthly meetings with them. How's the facility? How's the capacity? How's the ramp up? So there's a list of suppliers like that we're focused on, we're communicating, we're getting the right answers. I feel good with it, but there's no doubt there's risk in a supply chain that you're ramping up like that. There's no doubt.
And then, as you think about, growth over the next couple of years, you're right, you're going 3x. You talk about North American Transit. What about coach? Is there something in MCI? Or I guess I'm thinking about all the different parts of the business, right? You've got MCI, you've got ARBOC, you've got.
Yeah, let me talk about MCI.
Sure.
So MCI is going to be under 600 vehicles this year. They built 1,000 vehicles in 2019. In the magnitude of the supplier's capabilities, et cetera, it's absolutely a lower risk related to the new Flyer and the transition to electric. And the number of electric coaches that we're going to build is quite a low number. So the risk profile to MCI to get back into the 800, 900 buses, I would say is a low risk profile for sure. On the ADL side, the total volume, et cetera, I say is a little bit in the lower risk profile for sure, and the supply chain's ability on that. But we are making a transition right now from a BYD chassis, where BYD provides the entire chassis for an electric vehicle, and they have for the last number of years. We just launched our own electric propulsion system, which is made up of Voith, if you've heard of the company, providing the power electronics and the drive motor, and a battery supplier out of Europe that's packaged the battery for us. So it's a whole new supply chain, and we're just launching that product. So that's going to be and a bunch of other parts on that vehicle that tie into that whole system. So that has the same focus to ensure execution as New Flyer does, that whole program, and everything is good so far. But yeah, we're going to be ramping that up. ARBOC, there's really the volume. ARBOC, we integrated the New Flyer electrical architecture for the electric bus. So all the critical items on the Equus charge at ARBOC is the New Flyer system. So the risks are extremely low, and the volume is extremely low compared to New Flyer. So it's a non-issue for ARBOC as well.
Okay. So all in feels okay. And then what about the other pieces of the UK business? I mean, it's something that I know you're tangentially involved with. Have there been any other opportunities you guys have found? I mean, you were starting to integrate it, I guess is the nicest way to put it, back when you bought it in 2018, 2019. And then, we were sort of looking for, hey, 2020, let's get this thing going. And, any thoughts on what this thing looks like as we get to the far side?
Paul's on the call here and he can pipe in. Let me on a little bit of ADL when it comes to that kind of stuff. But from a supply chain point of view with ADL, we are collaborating all the time, and we do have common suppliers and that we collaborate on to get support, pricing, that kind of stuff. We also have a couple of things we do. We have a new product development sort of technology council that meets all the time. So we're absolutely calibrating on, the fuel cell system in their vehicle, which is also Ballard and et cetera, and that the new launched system with Voith, et cetera. We're constantly collaborating on the product and the issues we're having, et cetera. So at an engineering and supply level, those collaborations exist every month. Mostly from the level of take the best practices, watch out for this type of stuff. Let's make a joint decision. What's the best way to go type of stuff. It's a different vehicle. It's an absolutely different vehicle with different parts, et cetera. So, the synergies related to that, you can only get so many of those type of synergies. It's a different market. It's a different vehicle. It's different parts. And we got the Buy America over here on the transit. So I wouldn't say there's a massive amount of synergies to occur, but the sharing of the best practices, et cetera, is alive and well across all that.
Chris, it's Paul here. I'll just jump in on what David was talking about. The thesis for ADL, the acquisition, was to try and do operationally over there what we've been successful at doing here, leaning out the facility, removing non-value added activity, proper flow, pull systems in the plant, and all this other stuff. And yes, COVID dramatically hammered ADL the same way it hammered New Flyer MCI. Even worse, their customers are private operators, and so their hold off on purchases and the reduction in the market size changed dramatically. But the thesis at the time that we bought Alexander Dennis is that that market was going to recover because it had gone through 5 or 6 years of reduced deliveries. And it started actually quite strong in 2019, just when we bought it, it looked like it was going to recover. So they made major surgery on their facilities. They took out a lot of people. As David said, they've launched their own chassis now for the EV, which we're very, very excited about, because it allows us to kind of control our own destiny, not only the purchasing material, but how we make it, but also the service and parts and all this other stuff that goes with it. Its focus is to get it back on its feet, just like we're doing at New Flyer right now, before we get too excited about new markets. The margin profile will change over time, and we believe it will improve significantly. We are still looking at some new markets where they had been previously trying to sell and have opportunities to either export or locally build through a build partner their designs and so forth. Hong Kong and Singapore continue to go well. New Zealand continues to go well. And Alexander Dennis is on the mend, just like New Flyer is. We're all set back with COVID, but the investment thesis in the long term still holds true. We want to be a global bus and coach player. We think we can collaborate, as David said, across the company. And yes, we're hampered by Buy America in North America, or Buy Canada content in Canada and some of this other stuff. But the learning we're getting about what ADL does, or what ADL's competitors do, that then apply to insights we can get on this side of the pond, are invaluable. So you go back to our long range plan of a forecast of guidance through 23, 24, and 25. We're not promising to go to levels that we weren't at before. In 2019, we delivered 6,200 units. Last year, we delivered 3,039. I mean, absolutely, same as Dave's example on his seat supplier. And so we're not projecting 2025 to be 10,000 units. We're only trying to get back to 6,000 pre-COVID. But the margin profile will be dramatically better because of what we've done with our cost structure, but also what we've done with the margin and the pricing we put in our business. So that's what Steve has just called up on the top screen here. 2025, we only expect to be back to just under 6,000 units in total volume. So we're not promising a miracle has to happen, or that there has to be massive market shift or change. Our market share will likely go up through that period because of our success on win rates in zero emission, and the margin will be dramatically different. Overlaying all that, we took out $65 million of overhead and SG&A as part of our NFI Forward, and as you described, Chris, kind of some of the obvious or notable areas around overhead reduction and rationalization of integration of ADI and MCI for that matter.
So I guess the question, we've been trying to figure out is, a lot of the issues up front were always supply chain constrained, right? Which is why, we wanted to have the chat with Dave and start to understand, okay, so on the way out, is the supply chain ready to roll? And I think, David, you've kind of talked about the fact that, there's not only like getting stuff back to normal today, but then there's also the technology shift and the ramp. I guess the question is, what gives you the confidence that you think that we're there today? Like, I mean, the problem we've had is we've heard this, fair or not fair, over the last couple of years has just been, and I'm sure Paul loved coming on and telling us that, well, we got told this was going to happen, and then why happened? But why is it different this time, I guess, is what we're trying to say.
I'll give you my, short summary speech, or maybe it won't be short. As we moved through, 19, boy, were we jacked up. New Flyer was doing really well. The only stumble we really had was the launch and the readiness of KMG. And in fact, David stepped up and took control over KMG for the better part of a year and got it back to health. And KMG makes money. So that was a good, solid move, although it hampered our 2018 results. COVID, who knew how long, how deep, how the implications, not only for labor, but then, as David described well, the whole implications for the supply chain and so forth. He talked about all the things we're trying to do to get through it now, but also the change for the future. We didn't really talk about it today, but remember, we still got 600 freaking buses basically offline. Some of it that we got to finish because we're still waiting some parts. And as simple as that sounds, the part shows up. It's not quite simple to take people off the product line with tooling and parts into a parking lot to fix it, only to show it back to the inspector and the inspector wanting something different from the customer and so forth. So we still have a plan through the rest of this year to punch through the excess working capital and to start the year basically back where we were pre-COVID, or basically with what we get line enter, we deliver. So David talked about twice as much or 3 times as much inventory on the shop floor, band-aiding it until we have confidence in the supply chain. We've added to the resources and the teams and the technology and whatever around what we're buying. We doubled the time for the suppliers to fill. So we're finishing the bill of materials earlier and giving them not 6 weeks, we're giving them 12 weeks. And so there's all kinds of those things that are dramatically different. The other part of it that's different from now going forward in the past is we got hammered with hyperinflation. And so we made the choice not to send all our people home because we had such strong order book. So we knew we were going to absorb all kinds of non-productive labor. The second thing is we made the choice not to default on any customer contracts. And so a few of them, I think 9 helped us out with some price. Some helped us out with some working capital or some milestone payments. But the rest of them said, you know, we have a government contract, you're going to build to it. In this very small community as an industry leader, we felt that if we default on a government contract or throw our force majeure card to the customer, that's a little bit like signing your death certificate, because the whole world will know it's a very small industry. And in the Buy America world, where you have ever defaulted on a contract, you have to disclose it in every proposal you ever make. And so imagine the city of whatever going to their board saying, I want to choose New Flyer. Oh, aren't those the guys that defaulted on these contracts? So we knew that. So now what happens? We're bidding with way more confidence in our bill of materials on spec, on the cost of the bus. We're adding insurance over and above it for our own peace of mind that if we guess wrong on this part, we'll get it over on that part and so forth. And quite frankly, we've dramatically increased our margin expectations to manage through 23, 24, and 25. And quite frankly, our win rate on zero emission continues to go better and better and better relative to our historical win rate. The world is in a different place. Yes, there's still COVID and there's more cases today in China. And yes, we still have supply issues that David talked about, but they're not, what we're not seeing now is that it's industry wide or global. It's isolated part issues that are still having us limp around. And we believe that we can manage our way through that. So look, our confidence in the business this time around, and you're absolutely right. You've heard it from us now, 7 refis since March 2023. The irony is I applied to the federal government for the hardest hit program and they said we weren't hit hard enough. Well, that's a bit of a joke. We've got the same team in place. We did get rid of all the people. We have tremendous non-productive time today, burning off all that excess WIP that then becomes productive labor. We haven't had any customers fire us. And our win rate's going up and the margin's going up. So, you know, we're kind of excited about getting back to that pre-COVID level, you know, as we move into 2024. We still have WIP cleanup work to do. We got an issue, for example, in our electric buses where we and every bloody competitor in the industry learned the lesson the hard way around putting drains in energy storage systems. We've already started to actually deliver those buses. The drains are getting put in place. We'll punch through a couple hundred of those buses offline in the next kind of 6 to 8 weeks. And so we're really feeling momentum shift in we've hit rock bottom and we're on our way back up.
Okay. Dave, anything to add?
What we experienced in our supply chains from COVID was obviously a once in a long time event. Look, unless the same thing happens again, I mean, all cards are off the table, obviously, but the supply chain is close to being fully back to health. I'm very confident it'll be there shortly. It is definitely a little bit of a risk, the fact that we need to ramp up and we want to ramp up, you know, we need to ramp up our business. You saw it from 3,000 buses back up to 6,000. There's risk in that, but that risk is different. That risk if that risk hits the table and is a problem, that means you just potentially defer that ramp up a tiny bit and not significant. It's not the kind of stuff we're dealing with when critical line stopping parts. You get a phone call on Monday saying, as of next Thursday, I can't get you another single one. Because you know I had very tight supply. Well, all of a sudden it's gone to zero and here's what happens and boom, I give you no warning. That's not the kind of environment we'll be in on the ramp up, right? it's a totally different environment. We'll get the visibility, we'll be ahead of it. Yes, perhaps the ramp up could take a few weeks or a month longer, worst case scenario, but it's not going to be the type of scenario where we have 63% schedule attainment. Our schedule attainment year to date is back into the 90s, and it'll be back to 100% shortly. And if we have to defer the ramp up weeks or months, it's nowhere near the cost, nowhere near the the pain related to the past. And I'm confident we won't have to. Everything I see, I'm confident everyone in the industry wants to get back there. The suppliers want the sales. They're anxious for it, and everybody's eager to get back there.
Okay. Okay. Well, why don't we leave that there? But I do have a couple other questions.
Yep.
Steve, we talked a little bit about, there on top of like getting the business back up and running, there's a few other things going on right now. We got a number of investors on the call. Any updates on where the sub debt process is, the meeting, any of the other kind of nearer term issues that the rest of the community might care about?
Yeah, so I think as people probably here know, we announced on May 10th our kind of comprehensive refinancing plan, and there's kind of three legs to that stool. So one was credit approval from our banking syndicate on an amendment to our credit agreement, an extension, a 3-year extension with new covenants and lower capacity. And so we had a $1.25 billion revolver in December. We stepped that down to $1 billion. As part of this refinancing plan, that'll step down to about $760 million. And so as part of that, we had a gap we needed to fill in total kind of debt capacity. And in addition, we were looking to add additional liquidity to the balance sheet, help deleverage a little quicker, because we were obviously heightened leverage as we had lower EBITDA going through all the stuff you heard from David and Paul the last couple of years. So we had a plan to raise $150 million of equity, $200 to $250 million of second lien debt. As we started, having the conversation around the equity, we had a private placement with Coliseum Capital, which is one of our largest shareholders, to do the full $150 million of the equity we needed. But there was also, in our discussions with Coliseum and our approach with them, there was the opportunity for an alternative offering to get other shareholders involved. When we went out and looked at the market and demand and inbounds we'd received, we actually had very, very strong kind of interest on the equity side. So we ended up upsizing that. So we went with $92 million from the alternative offering and $133 million through the private placement with Coliseum. So we upsized the equity to $225 million. And then we lowered the second lien debt to $175 million. So still total $400 million of proceeds expected. And again, $250 million of that is kind of permanent reduction in the debt capacity on our main revolving credit facilities. And then the rest is to drive liquidity. So pro forma, post those two transactions or those three things together, we should go from about $124 million of liquidity to $250 million of liquidity, using Q1 pro forma numbers. The shareholder vote on the private placement, because Coliseum was on the board and because they were going to be going over 20% ownership, that will happen on June 27th. So any shareholders of record should have received, your materials by now. They were mailed out last week. There's also details on our website. So that happens on the 27th. The second lien debt process, we're deep in that right now. So we've talked to a bunch of different investors and potential folks that are interested in the second lien. We're targeting to get everything finished by June 30th. So the shareholder vote on the 27th, and then a couple of days after that to close everything, but trying to get the second lien, further along before then. And then, we have a waiver with our banks until the 30th. If for whatever reason, because there is obviously a lot of legal documents and a lot of things that need to be finished in a short amount of time. So if for whatever reason we think we need to go beyond into July, don't expect that to be an issue from the bank side, but we're still really pushing hard to get everything done by June 30th. And like I said, all three of these elements are contingent on each other. So the equity, the second lien, and the kind of credit amendment, the new credit amendment, all three of those have to be completed at the same time. So they're conditional. So that's why we did subscription receipts for the equity offering. So those funds are held in escrow. And then when everything closes, those funds will be released. So all that to say, feeling really good. We're making our way through it. Obviously a lot of work and a lot of moving pieces, but was really pleased to see the strong demand from shareholders for the equity offering, and happy to have that piece done, because that was a big component of this plan. We have credit approval from all of our banking syndicate on the amendments and the new covenants. And it gives us quite a bit of runway because the covenants don't resume the coverage, like interest coverage and leverage covenants don't kick back in until Q3 2024. So, Chris, as you heard from David and Paul, we're in this ramp up and recovery, so we won't really have kind of a strong LTM number. Will take a bit of time, so that's why we push that covenant out to Q3 24. So all that to say, everything's moving forward. A lot of work between now and when we finally close everything. But the next big date, I would say, is June 27th with the shareholder vote.
Good, and you're feeling comfortable about getting the sub debt done by that point as well.
I think so, yeah. Like, I think we're moving it along. I think there's, obviously a few moving pieces on that one, on getting, term sheet and terms and agreements nailed down. And there's language that goes in the second lien that has to get incorporated into the credit amendment and new credit agreement, or sorry, amended credit agreement. So I think feeling confident that we'll have news before then. And so hopefully before the 27th, but yeah, pushing really hard to just bring all this together. Like I said, we've been deep, I'd say, with the second lien folks for a while now on, their diligence and their assessment of the business and analysis of what a second lien financing could look like. And I think as again, we started at 250, now we're down to 175. So it's quite a bit lower what we kind of originally went out with to where we are today. So very strong, I think, appetite in the market for that financing, and have had some really good conversations with a variety of North American institutions.
Good, and the range still kind of in line with what you put in the press release?
I think, the 12 to 15, obviously, hopefully we'd love to get it as low as we can, the 12 to 15% coupon. I think, like I said, when we originally started, we were looking at up to 250 million of debt and with a tenor of kind of 3.5 to 5 years. And I think we've been continuing to push, probably a shorter tenor and maybe hopefully a lower coupon. But, like I said, some of it comes down to negotiation and discussion with what's out there and what's in the market. Obviously rates have been moving around a bit on, Canadian jump, the Fed has held theirs. So there's that impact as well, just the overall macro environment. But I think, given we did lower it to 175, I think we're hopeful that we can keep it on the lower end, but I think it's still that 12 to 15%.
Fair enough. All right, folks, we've got a couple minutes left. Don't know, first of all, David, thank you very much for doing this with us. I know it's not normally in the job description, but usually we drag Paul out for these things. I don't know, Paul, if you or David want to kind of wrap this thing up, but thank you very much, everyone, for your time. But, Paul.
Well, I'll just say, Chris, look, thanks for doing this. Thanks for your continued, support of drilling down for the shareholders and trying to understand what's going on. It's not lost on us that we've been at this kind of reset since March 23 of 2020. 7 credit refis in that window is ridiculous. We don't have a demand problem. I keep saying that, but we're really bullish on demand, not only in terms of the customers rebounding their operations, but the money in the system to help look at zero emission and the infrastructure and so forth. Getting back to business instead of running around doing equity and debt raises and credit refis is something we all look forward to, because it's very, diversionary to what's going on. We are cautious in our ramp up. I don't want anybody to expect we're going to go from 30 buses a week to 50 buses a week in a flash. As we've done in the past, we will do it gradual, 30 to 31 to 32 to 33 over weeks at a time, which is why we don't really get back to what we want to do from a run rate pre-COVID, really to the end of 25. Our forecast on the surface looks very aggressive, but there's not only a volume recovery, there's a margin enhancement, and then there's a cost takeout. And if you put all those together, we did 330 back in 2019 with only ADL for a partial year. So, I hope we've provided some balance and insight into the story. You asked David a little bit about insourcing. We insource roughly 15 to 20% of our COGS today. And of course, depending on the spec, some of that, gets outsourced or bought from other players. We've always said the stuff we would look at is where we own the drawings. So in some cases, we could insource more if it made sense, but then it's got to be a trade-off of the capital deployed, the special skills to make that stuff, and then the skills from an engineering and a technical perspective to stay current. And so David's example of us, we're never going to make inverters, right? That's just not our game. And compare and contrast, we chose not to be like Lion Bus, for example, who put $100 million into a battery packaging facility. we want to take the modules and put them into our containers and control that game. But I'm not interested in having this big, massive facility of packaging batteries, because we think we could be smart buyers of technology. As that technology, as the price, as the chemistry, all that stuff changes over time. We think we got to be smart buyers and integrators, as opposed to heavily burdened with people, overhead, infrastructure, cost, technologies, and so forth. And so that's all inherent in our strategy. And the last thing I'd say is, if zero emission adoption goes faster, we're ready. If it goes slower, we're ready. This dynamic of being able to build any bus on any production line, independent of propulsion, gives us infinite flexibility. And I think that's proven to be very good for us as we've now ramped up the size of the order book on zero emission. But we're still building diesel buses. We're still building natural gas. We're still building hybrids. And so, we're partnering with the customer on how to do that. And everyone's going to be different. Their political environment, their funding environment, their readiness for the infrastructure and their garages and their training and where they're going to get energy from and so forth. It's not a matter of if, it's just a matter of when. And so that's why we believe it's an evolutionary story. So we're feeling pretty bullish around here about the recovery and the game on for us. All
right. Well, I think, guys, we're out of time. I think we'll leave it there. Once again, David, thank you very much for taking the time to put up with us. Paul, Stephen, we'll look forward to talking to you shortly. Hopefully we'll hear from you either before the vote or after the vote, and we'll go from there.
Absolutely. Okay. Thanks, Chris. Thanks, everybody. Appreciate it.
Okay, bye.